So I lost quite a bit of money, and for those who don't know, I manage a $9 million family fund, and I opened this gold short put position on Friday, March 6th, and the position was doing pretty well actually. I think just before this drop, we were up like 85% of credit, and the position would expire on Thursday. So it was a position with maybe 20 days to expiration, so not too many days. And as you can see, the prices, the strike of 42.50 is pretty far away out of the money. And I guess one of the biggest mistakes that I've made is, kind of ignore fundamentals on this day. It was a Wednesday, even though the price kind of went all the way down over here, we were still, I think, up quite nicely, like maybe 60-50% on the position. And this is where I should have exited the position because fundamentals have changed. But at the same time, there's just a few more days left, to like a week or 6-7 days left to expiration, and in between there's a weekend. So I thought, what are the chances that gold will make a historic run and run all the way down to our short strike? And guess what? This is exactly what happened. This is the biggest gold decline in history. So it basically dropped, if we count Wednesday, Thursday, Friday, and then we have the Monday, it dropped at the very worst 18%, and this is it basically 4 days, right? 18% in 4 days is just historic for gold. This is what I would consider a black swan event, and I lost a total this month of around $185,000. Now, this is about 1.79% for the month at least. The gold position itself lost a bit more, but I also had two profitable positions which help with the rebalancing of this month's loss. But down 1.79% this month, which is not too bad. I'm actually proud of it. And overall up on the year 1.64%, which is not a lot, but at the same time, the S&P is down like 7% year to date. So, and we are up. So I'm pretty happy with it. But this was something I've never experienced before, especially with gold. And I've traded through March 2020. I've had positions, and these drops were just nothing compared to what happened with gold here in just a few days. And there's a combination of things, but at the end of the day, I ended up exiting the position on this day, on Monday. It was actually Sunday evening that I exited the position, where price was, I think, somewhere around here, 40. Actually, it was under 4,400, so very close to the short strike, and taking a loss on this position. The other two positions that I had, and we have a crude oil position that actually expired before that, I believe, was a crude oil position. Actually, I think it was a different one. Yeah, the contract already expired, but anyways, it was a crude oil position that I entered, a short put position that I entered on Thursday. It was strike 56, and this position also had about 20 days to expiration. And obviously, since we sold the put, the whole war broke out in the Middle East, and the position expired worthless. And the other position that is actually only expired today is a short wheat position, a short call wheat position, where we sold it right on this day over here. As price went up, strike 700, and it worked out pretty well. It just expired today, worthless pretty much. So with that, obviously, I'm still down on the month, but at the same time, I'm pretty happy with how I sized the gold position, because that position was pretty scary, to be quite honest. And this just kind of helps me realize that I should always be keeping my position size small, and always be preparing for a crazy drop that happens like once every 40 years. But of course it's going to happen to me because this is just how trading works, right? So big lesson here is to keep position size small, but at the same time, I'm also pretty much gonna change how I trade, or actually, change what I'm trading with, what kind of vehicle I'm using to trade. So instead of trading options, I'm gonna start just buying or selling the underlying future itself. The reason for that is this way I can control the loss that I'm going to be taking, and we have a potential of making quite a bit more money if, for example, price shoots up like it did before the beginning of the war. Obviously, I wasn't 100% sure a war would break out, but once the negotiations failed on Thursday, February 26th, I knew there will be some kind of escalation, and obviously it ended up being quite a big escalation over here. And obviously, if I would have just bought one future contract per 100K of capital and just had a stop loss of about maybe 2.5% of the account, we could have made a very nice profit, 20-30% on the entire account. Instead of it, obviously I just sold a put and made about 1.5% on the account with the short put, which is also respectable. But at the same time, there's many situations where I miss those moves, or I miss capitalizing on these moves, which do tend to happen quite a lot, given how I trade, right? So there's a trade that I did actually on soybean. I entered right on this day over here, or actually, yeah, at the beginning of the day here, for a long position. It was actually a future position that I entered, and I ended up exiting just on Friday. So this was a pretty profitable position, as you can imagine, with very limited risk, and I entered it with futures as opposed to options. And there's many different trades like this that I've done in my career, especially recently as I've been more directional, where basically they would have profited so much with such little limited risk that it's been pretty crazy. I've done a few trades on copper to the upside. Obviously, they made money, but again, I was selling options, so my profits are capped. But at the same time, this is kind of my evolvement, and it all depends on my confidence of choosing setups. And I think I have a pretty good system and understanding of where and when the odds are clearing in my favor, and just trade based on that. So currently, don't really have any trades opened up. Just kind of want to see what's going to happen with the negotiations, because this conflict pretty much drives the prices for everything, right? So we'll see what's going to happen. Something interesting is maybe a position that, again, this is a position I've taken on a demo account. This is cotton futures, and on this day we had a pretty big price increase. I waited for a pullback, and I entered long futures right over here with a stop loss right below this candle. But again, this is a demo position. Just wanted to kind of get my feet wet, I guess, especially with a product that I don't really trade much. But based on the fundamentals, there's a possibility that China will be buying other U.S. Crop or other U.S. commodities like cotton. So price kind of went up. It all depends again on what's going to happen between Trump and President Xi when they eventually meet. I think it's the beginning of April. But this is kind of an idea of how I choose my options trades, right? So I'm going to do the exact same analysis I always did. Nothing's changing there, because these analyses have been working really amazing for me, basically for the past over 10 years at this point. But I'm just going to change the tool that I'm using to capitalize on my assumptions and on my decisions and analysis. So I'll keep you posted. We'll see what's going to happen. I think it's going to be a pretty awesome year, especially with the futures. So I'll keep you posted, and thank you so much for watching, and I'll catch you in the next one.